This is part one of a three-part video series on the basics of the double bucket method. In this video, we will give a high-level overview. The idea behind the double bucket method comes from a retirement spreadsheet similar to this, where you break up your retirement span into age range divisions, and we're going to call these divisions time buckets. For each time bucket, you would specify a desired income. And in this scenario, we're going to say we require $100,000 initially in retirement, and then that's going to go down a little bit for the last few years of your retirement, assuming your discretionary spending requirements go down. Also, we're going to, from that figure, we're going to subtract off Social Security. Here we're delaying Social Security until age 70. The next column is other income. Let's say you take in a little part-time income earlier in your retirement. You would also subtract that off of your desired income. The next column is taxes. You have to add this in, and that from that you come up with a yearly withdrawal. So let's take an example here. Let's say the 70 to 75 bucket. Your requirement's $100,000, but you're going to take in $30,000 Social Security and $10,000 of other income. That nets you with $60,000 requirement. You pay $6,000 in taxes. So the withdrawal from your principal is going to be $66,000 during that bucket. The next column is just the total amount in the bucket. So you simply multiply your yearly withdrawal amount by your number of years in the bucket. So here we have 5 years times 90,000 is 450,000. Now the next thing you need to do is calculate in today's dollars the amount of money needed to satisfy each one of those buckets. So we have an expected return amount, and if we look at the age range from 85 to 95, this is money that you don't need for 20 years or more. We're going to assume a 6% expected return, and we get that assuming that the stock market and other riskier investments can return 9 or 10%, and then we will subtract off inflation. And because we subtract off inflation, you can specify all these values in today's dollars, and subtracting off inflation will account for that or give you an inflation adjusted amount. So once you have your required savings, you can simply total up this column, and this will give you your principal requirement to satisfy this plan. Now a financial planner may look at this and say this is a little risky. And the reason they may say that is that maybe inflation isn't going to be 3%. Maybe it's higher than that. Or maybe the stock market doesn't return quite what you think. But still, we're in the ballpark of a required amount. We may want to add 10 or 20% to give us a little bit of a cushion. But this is the basis behind that spreadsheet and behind the double bucket method. Now, to run the double bucket method, you simply would take these age ranges into yearly withdrawal amounts and then run the method. Now you also need your expected return values and the asset allocations for each one of these time buckets. However, we have estimates, so you can just use our, or I should say suggestions. You can just use our suggestions, or you can override those suggestions if you think you have a better estimate for each one of those time buckets. Okay, so now we're ready to run the method. Let's see how that would work. Okay, so from your retirement spreadsheet, you're going to pull in your age ranges and your yearly withdrawal amounts, and you're going to add in the time bucket allocations. Like I said, you can use our suggested defaults there. Once you have that, then the method will calculate your required principal, and also it will generate a yearly asset allocation table, and this will show for each year of your retirement how your assets should be allocated. We're just showing question marks here, but the actual method will have values. So it may say that you in the first year of your retirement you need 10% cash, 20% gold, so on and so forth. And in stock market, it would be a higher amount. What you'll notice when you see an actual table, this will become more conservative over time because you, as you get closer to the end, you want to hold a pretty conservative position. Early on, though, you can take a little more risk and invest in the stock market. Okay, so this gives you an idea of how the method works. We're now going to go to the website in our next video and see how to put this to practice on the website.